Welcome to the DeFi Standard, and this is Mickey B. Fresh.
Okay, as far as the financial, like the global financial reset, um, is there any way you can kind of like give us the picture of what it is that we should be expecting and how soon do you think it's going to happen?
I don't think that there's going to be any sudden radical change. I don't think so. I think things are going to be, I think they're going to be reasonably gradual. I don't see any reason to think that there's going to be like one day where somebody, radically changes things. And I'll tell you why. Um, Central banks and governments are more conservative than the Catholic Church. They're unbelievably slow moving, and they risk like their entire country's economy if anything goes wrong. And they're extremely slow moving and tentative. And I know that's not what you guys want to hear. I'm sure there's a lot of people who want to hear that something will happen like quickly and drastically, but I don't really see it. There can be rapid adoption of new systems, but I don't think you're going to see like country economy level changes rapidly. I'm sorry to say. I'd like to think so. Unless AI, unless you're one of those people who thinks AI is going to do that. I'm not. There are people who think that AI is going to, 10x the economy in a decade or something. Um, I, you probably even heard more than that. You probably heard people say like 1,000x the economy in 8 years or so, 5 years even. I'm not one of those people. I don't.
So what does harvesting volatility for yield really mean? But before we get into that, we first need to understand what utility is and the economic models of these networks. And those are the two topics that I think are the least understood. So utility. Something we've heard over and over again, going back as far as 2020 with the Calgatron blocks. Utility and real world use of the asset. That's what's going to drive price. 3 years later, we see that does not drive price. So what does drive the price of an asset in this new asset class? And I've seen a lot of posts on Twitter, manipulation, it's JP Morgan, because it's not regulatory clarity. We have the so-called utility. So what is it? It's because we don't have demand and there is no ecosystem. So there's been a heavy focus in our community, especially on utility and RippleNet and banks using an institutional. But that's not what drives value. And that's what's missing is the demand and the intrinsic value of the asset. So what I would like to ask everyone to do is to open your mind, clean slate, take all that banks will use, XRP, all the allocated, all those other theories, take them, throw them out the window, and I'm going to start afresh. XRP is just like any other crypto. You take it off a pedestal. And what I find most interesting about the community is that which is a reverse of what it should be. And it's kind of strange, is that typically in most of these communities, when people hear DeFi earning more yield and earning more of the asset, they get excited. In this community, we get excited over conspiracy theories, over backing assets with gold, public assets, and overnight price jumps. That's the disconnect. So we need to bring everyone back in and bring others back in and bring new people. So what's the difference here between crypto commodities and crypto capital? I think this is a good way to start off to understand what the value is in bringing yield to an asset. So right now, XRP and Bitcoin are crypto commodities, tokens whose ownership doesn't yield an ongoing stream of value. The key detriment of this is whether ownership of the token is a requirement to participate in the system and qualify to receive cash and value flows. if the asset is a requirement, it's a crypto capital. If it isn't a requirement, it's a crypto commodity. Ethereum 1.0 is a crypto commodity. ETH 2.0 is a crypto capital. So that's a good just reference right there of the difference. And forget the whole regulation and what they call security commodity. This is at the economic fundamental value analysis here. All right. So this is what drives demand. And this is constantly evolving. You can't compare it to stocks because, to an extent, Galaxtron was right in a lot of points they made in that compared to stocks. It is true, pure speculation, but there's so much investment in the capital markets and so much institutional money that it does line up with if a business is doing better or there's potential future value of earnings that will drive the value of the stock higher, even though it's not directly connected. Now, what's the difference with crypto assets here? And he makes great points, just misses on where we're at now and that demand side and the intrinsic value being in the network itself. It's not in the utility of the asset on RippleNet. There's no value there. That's not what's going to drive the value. So a little hint, heads up before we get into this. And it's going to be a little gut check for everybody. Let's put it that way. So crypto capital, this is the asset we want. Why do you want to hold the asset? Everyone's sitting here holding their XRP in their cold storage and waiting for something to happen. Bank of America is this. Well, we need to change that mindset because nothing's going to happen. I'm telling you right now, nothing's going to happen until the ecosystem and there's demand for XRP. And it's coming. It's coming very soon, but it's not here yet. And it'll come in different waves. And I can't answer the question of when or how much. But I can tell you what. A token whose ownership provides an ongoing access to something of value and can therefore be valued based on the net present value of its future cash flow. Any asset that is staked, bonded, or otherwise, let's throw in there, deposited as liquidity, committed in order to claim on value flows can be considered a crypto capital. These can be valued by taking the net present value of their future cash flows divided by their value flows they're expected to generate. So this is the model that XRP is going to have. So we're getting used to that. Is it here now? No, but it's going to be, and it's going to be here in a different way than ETH 2.0 is. It's a very different model. Because I know, I'm going to listen to the video from David Schwartz right now, because I think this explains best of how this is not just providing liquidity. You're putting your assets, when it's in the AMM, they're going into literally an investment vehicle. That's what it is. It's taking your assets and it's earning in 3 ways. What are those 3 ways? So this is not like putting them in Uniswap or some Sushi Swap or some other DApp or DEX. This is a innovative trio of technologies built at the network layer of a 10-year-old purpose-built value exchange. It's now getting its economic model that it's missing. And we'll see here, all assets need economic models, all networks. A token is a crypto economic unit of account that represents or interacts with an underlying value generating asset. A token's value is made up of its intrinsic value, the percentage of the token's value that derives from the demand for the underlying asset, and its speculative value, the percentage of tokens value that derives from demand due to expectation of future price increase. So that's one way. While speculation is nice, it's hard to control and predict, and it puts projects at the mercy of short-term oriented investors like our friend below, Wen Moon. So are you one of those Wen Moons? And I think this is where everyone's got to take a step back and think to themselves, what are you? Are you a fundamental value investor, or are you here for the quick pump and you want to make some money and you want to get out? And then people exaggerate that to, oh, it's going to the moon overnight and all that nonsense. That's distracting to those who really want to capture the value, because it's a lot more than just speculation. And the TA, that's great, but that's going to go less and less important as time goes on, because I'll reference the Galvatron blog again, because as much as it's missing things, it does have things in there that are good. It says that speculation can't be the only driver of this, because they're not just an asset. It's a network, it's a protocol, and it has users that drive real demand. So now, instead of somebody just buying it so they can hope the price goes up, they're buying it to use it and to earn yield. So utility, liquidity, and yield. Those three things are basically what you could think of like XRP. Its utility is as liquidity, which earns yield, which then drives its demand. If you don't have demand, and everyone says utility, but utility doesn't drive price. Demand does. So, and in this blog, this is just the beginning of it, recommends investors focus on intrinsic value. A token's intrinsic value is dependent on two factors: the value created by the underlying asset and the percentage of which value is captured by the token. Now, speaking of value captured by the token, assets like XRP that are used on RippleNet, there's an argument to be made that is that value being captured by Ripple's equity, or is it being captured by the token? It's on the ODL goes over the blockchain in transaction transfers, but Ripple's subsidizing it with the incentivizing the market makers, incentivizing the whole network to ramp up. It's not designed to drive price, so everyone knows that. But it's a significant player and product to drive demand. And it's going to do that because probably the biggest thing that I think is unknown to the community is that ODL, RippleNet, Liquidity Hub, all of that is going to be tied into the XRP ledger. There's this disconnect that they think's happening, like, oh, there's the ledger, oh, that's retail, it's not made for us, oh, it's just the institutions. Like, that attitude's the worst, and that's why it's so upsetting to like myself, Crypto Eddie, when people say, oh, it's only for institutions. You're doing damage beyond damage, because these poor people are believing that, and they don't realize that's exactly the opposite of what they should be thinking. And it's unfortunate, but that's where we are now. Things will change once people see and visualize, but this is for all the people who want to prepare. Because if you're not prepared, then you're going to be late, and you're going to be running around with these wild speculators trying to figure things out. Well, others know what they're doing because they took the time to learn and understand. It's not that difficult, but it is new and it is complex. But for those of you who already have a basis, it's not going to be that difficult. And even then, it's about devising a strategy and being at the forefront and taking advantage. We can't devise a strategy right now. We don't have enough information on the pools, but you will be able to. But are you prepared to do that? That's the question. And so tweaking the token model such that the value is transferred from the company's equity to its token and aligning incentives between founders and token holders. What does that sound like to you? This is why the escrow, I never understood why the whole community was not thinking that those tokens, the extra supply is going to ultimately come back to incentivize liquidity on the network. It was always going to do that from the beginning. I don't know why this allocation of debt, because you're making it something bigger than it is. It's big enough, but it's. I really don't understand some of it. Like, I understood like back in the riddle days, but after that, it was like enough. And then we have these wacky theories that people just hang on, and I don't understand it. It's pretty exciting if you just looked at the facts. And I find that the most interesting because the rest of the crypto world doesn't see it coming yet. but it's coming. So buy and burns, that's not something probably we're going to see on the XRP ledger, but in a way, we kind of have that with Zahao. You know, if you want to move your value over to the Zahao sidechain, you got to burn XRP. That takes the supply off out of existence. And okay, yes, there's a small little inflation rate there, but that'll get chewed up by the hook's execution fees. So that's going to continuously put deflationary pressure on XRP. And I'll be doing a video on that as we get closer to their launch. Both of these involve giving the token a yield, transferring value from the equity to the token. In the case of the token buy and burn, this is widely suggested by Vitalik. You know, those are more for like protocol tokens. And there is a big difference. This article doesn't separate it, but we're going to go through the CFA Institute. And that is probably the best investment of fundamental analysis of any paper I've seen to date. But this kind of just hits home a little more on what is relevant to XRP. Token economic model design is extremely important and an underrated area for both investors and cryptocurrency projects to think about, and communities. Project with a weak token economic model may see its token price fall even as the project itself succeeds, simply because the token is not capturing any of the value created by the project. And another problem, high velocity. All of you want to say, all these tokens, transactions per second. Doesn't matter. Doesn't do anything. It's just pass-through value. Pass-through value does not drive price. So what does drive price, though? So the velocity of a token is inversely proportional to the value of the token. The longer people hold the token, the higher the price of each token. So this is intuitive because transactional activity. So, for example, how all this hoarding and people want to hold the token. There was a time, I'm going to go back and touch on a couple key quotes that are always referenced by people to try to spin their narrative. One, XRP can't be dirt cheap. Well, it can't be dirt cheap if it's successful, but that doesn't mean it has to be high. What David Schwartz said there, and let's not take his words out of context. It's only going to be high if there's demand for it. Now, there's been some, things they thought were going to happen, and we know for a fact from the Prisma documents, they expected to happen. That just didn't early on. Like they expected more natural liquidity to come as they went into more corridors. But did you really think that ODL was going to be in every corridor with an exchange and that speculative trading volume was going to drive XRP to be a global bridge asset? Because that's what I hear most of the YouTubers explaining it like. Your generic, just every day, just same, pitch for the last 3 years. It's not. It's not. It's much more than that. And it's about getting it to 40 corridors we got, right? 40 corridors. That's great. That's one application. There's no demand. Even David Schwartz was miscalculated when he said that, well, if you don't know what asset you're going to need next, you're going to hold the asset that is liquid to every other asset. Well, that hasn't played out. Why? Because of volatility. So to an extent, like things like the price set were thought of in the right concept, kind of, but you don't need a stable price. But you do need the volatility is of risk, and that's not enough just because I can move to the other asset, that I'm going to hold the volatile asset. But this is where the AMMs come in. It completely solves the problem and creates a whole dynamic economic model with 4 different types of participants at the network layer, putting in probably the most advanced, innovative value investment vehicle you've seen to date, because it earns like an arbitrager, it earns like an exchange, and it earns like a market maker, all put into one. And you could hold XRP and USD as a hybrid stablecoin that's semi-decentralized, or almost all decentralized, and use that then as collateral. And you still earn those 3 ways. And if an entity was going to do that, then they could come instantly out to XRP and use it any way they want. So it's much better than having this set stable price. Why would you ever want that? That creates no ecosystem. It does nothing for anybody, and it makes things boring. This it drives economic demand, drives new players in, arbitragers. And everyone who's here got their nano ledgers, I'm going to hold this till 10 years. Well, things have changed because now you're going to have to provide liquidity. And someone said, ooh, impermanent loss. I'm not going to go near that. Ooh. Well, as you learn more, I'm not going to say anything more now, but you just keep listening and watch the videos and follow the content that is at the forefront. Don't get stuck in 2019. Over time, the AMMs, the way it's designed, and every pool will be different, drives 3 ways of value continuously every day, all day. And it does this in a way that's organic and natural. There's nothing else, literally, on the planet does that. Why is it able to do that? It's able to do that because ODL and Liquidity Hub will be running through the volume through there, as well as the whole ecosystem, the DeFi ecosystem that develops. Plus, we'll have sidechains. We'll have Futureverse with the native token XRP, EVM sidechain, staking EXRP, Zahao burning XRP, and Flare minting FXRP. And then the AMMs locking up XRP as liquidity is its utility. But it's not locked up because your opportunity cost is 0. You get the LP token. So now you're able to provide this liquidity, which earns a compounding interest. And I just released a blog on compounding interest and why that's so important to assets. And I'll link it in the description below. And the next video is going to be on that to show what the power is of that. That's more wealth generating than moonshot. Like, I don't really care if you're here for the quick pumping out. That's going to be watching the video then. This is for the people who want to truly generate wealth over a long period of time and understand that doesn't happen overnight. But along that way, how can you maximize that? That's the question. It's a new asset class. So there's always opportunities that others aren't aware of that if you're at the forefront, you know. And this is like nothing else we've seen before because it's developing in real time. And the layer ones, their intrinsic value of the token, of the native token, is not in the token, it's utility. It doesn't have any utility by itself. It's the protocols and the network that underpins it. That's where its intrinsic value is. And the usage on that network. That's key because ODL is not that. So that's why you're seeing no price rise. There's no demand. It's only demand. You can't access it. With the AMMs, 8 billion people on the planet can provide liquidity with XRP. That's what we need. That's going to be a driver of demand. And then the volume, it's the chicken and egg. How do you get people to provide liquidity if there's no yield to be made from providing that liquidity? You would have to subsidize it. But if you have ODL, what they chose to do was subsidize the payment flow and volume first at the institutional level, and then bring that back to the network, and then the network will earn all organic yield. And it'll earn a spread against the central limit order book. So it takes advantage of its key features that it uniquely has that are advantageous versus other networks. And those are some of the key features. So to finish up here with the economic model, profit share. So providing the token with the yield, turning it into an asset that generates cash flow. This is big. This is at the heart of every network right now. You could generate cash flow. Now, cash flow isn't all equal. There's different ways. Like staking is pretty much almost every network is staking. Flare is going to have some staking, but at the heart, it's a data provisioning network. And it has a collateral system. So that's a little more complex. We'll get to that in definitely another video. but they're not too different. The liquidity pools on XRP Ledger and what you'll see with the collateral pools on Flare. So just this concept of these pools, and you're owning a share in the AMM pool. So that's the next video. These are going to come in waves. It's just a lot to take in, but I'm going to keep repeating myself because it's the only way I've realized that people are able to catch on. And as you see more visuals and you hear somebody else say it, you hear David Schwartz say it, just listen to what David Schwartz says. Like, don't say, oh, he's the CTO, he's just saying that. No, he's saying that because that's what it is. There's no flip of the switch. And when he was asked, so we'll get to that after this. So profit share reduces token velocity by forcing people to hold a token in order to have the right to generate cash flow by providing work to the network. Now, this is a little different than like your yield farming or liquidity mining. Providing the work. Let's see, what's the big work that you have to provide? You gotta deposit it in a pool where you lower your volatility risks and downside. Doesn't seem like much work to me. And because you'd be half into USD, because those are going to be the biggest pools that will drive the most volume. I'm just using that as an example now, but there might be others that will have different benefits. Now, this is at the lowest layer, so you could have things built on top that add in additional rewards. Plus, you have the incentives that will come probably from Ripple or the network. And they're going to hold the asset because they're generating real cash flow. And they're providing a service, so the network benefits. So everyone now can have deep liquidity and access the trading, and will get new assets. Bitcoin will be decentralized on the network. Tokenized assets, fiat. We need to drive an ecosystem. This disparate, like out there, RippleNet institutions only thing, that's not going to drive the price. They're not holding XRP. Not a bank in the US is using XRP. I mean, here's how I want to put it. If tomorrow Bank of America made an announcement that they went to Coinbase and bought XRP, who cares? Doesn't do anything for the prices. Nothing. If that's what you're waiting for, then you're just going to constantly be disappointed because you're looking for the wrong things. And there's a lot of people looking for that. ODL is not designed for the banks. And just the fact if you're thinking that means you're missing what Ripple's telling you is where these products are designed for the institutions and the payment service providers, customers. But everyone wants to make it a little exaggeration to it. The banks need it at 100. The Treasury needs it. Is it going to be part of the Fed Now system? Like, that stuff is all harmful. It just damage to people. It's like a head injury. It just keeps doing damage because you can't. It's going to be harder and harder for you to see what's really in front of you. And so proof of stake is the one known. But in the end, when it comes down to in a couple years from now, and you have Ethereum heads up, Ether, right, versus XRP, I think the tokens of the native networks you could compare as competitive. But the networks themselves, I don't think we should think as competition, because XRP could be used on Ethereum just as Ethereum could be used on XRP Ledger. So it's more of the tokens that are competitive. Now, they're the assets that are intrinsic values derived from those underlying networks. And they have native economic models like proof of stake to earn 4% yield. Those liquidity tokens and depositing liquidity is going to earn a lot more than 4%. I'll tell you that. So let's listen to David Schwartz. I'm Mickey B. Fresh, and I'm out.
Marius highlighted liquidity at the beginning. Again, that's one of those chicken or egg. People don't adopt it unless there's enough of those counterparties and liquidity available. And so it's really about kind of both having supply and demand emerge and kind of interoperability between assets of interest, and then the marketplaces that facilitate that interaction and that matching process, whether that's through centralized exchanges or DeFi as it happens.
I was incredibly excited about the work I did on the automated market maker for the XRP ledger, because one of the things that people perceive as a big downside of cryptocurrencies is their volatility. And an automated market maker is sort of an engine that turns volatility into yield. So that was just incredibly fun to me because I spent a lot of time like analyzing things like Forex markets and trading. And so that just like played to the things that I find the most intellectually interesting.